This week, the Australian dollar rose above 75 cents for the first time since July 2015. It has been enjoying support from US equity prices and also the ongoing rally in energy prices, particularly oil. But most eye-catching has been the surge in iron ore prices. Last Monday, iron ore prices jumped 18.6% in one day, the largest percentage gain on record. Prices rose above $63, printing highs since June 2015. And yet this week we also saw some updates on China's imports and exports, which were weaker than expected and certainly didn't indicate any surge in demand for iron ore. So what seems to be going on? Well, certainly one thing we've noticed is a sharp increase in speculative trading in iron ore futures. These are traded in Dalian, China, and the volumes on these have exploded in recent months. Indeed, trade on Tuesday was greater than the entire volume of China's imports over last year. The Australian dollar rose to 6-month highs against the New Zealand dollar, above 112 this week, as the Reserve Bank of New Zealand surprised most forecasters by cutting its benchmark interest rate 25 basis points to 2.25%. The RBNZ was concerned about volatility in global markets, particularly China's economy, and a fall in inflation expectations in New Zealand. Westpac has long expected the cash rate to fall to 2%, and we retain that view, with June the most likely time for a rate cut, but some chance of April. European central bank policy meetings always seem to generate volatility in FX markets, and this week's meeting was no exception. The ECB announced a raft of new easing measures, in particular increasing the pace of its quantitative easing or money printing program from 60 billion per month to 80 billion per month, and extending the range of assets they can buy to now include European corporate bonds. They also lowered the deposit rate for banks who hold deposits at the European Central Bank from negative 0.3% to negative 0.4%. There were also some other easing measures. All of this drove the euro lower initially. However, in the press conference, Mario Draghi, the European Central Bank president, indicated that he didn't think that further easing measures were very likely. This was enough for the euro to start rallying again, and it ended the session higher. Going forward, we do think that these measures will have an impact on the euro, weakening it over coming months. That's likely to be most evident against the US dollar, but the Aussie dollar may also benefit. How quickly the euro resumes its downtrend against the US dollar should become clearer with Wednesday's FOMC meeting. The Federal Reserve is extremely unlikely to raise interest rates at this meeting, with markets pricing that almost a zero probability. But there'll be great interest in Chair Yellen's commentary on the economy and also in the quarterly forecasts on interest rates, the economy and inflation. We expect these to indicate that the Fed continues to plan to raise interest rates in the months and years ahead. This is likely to support the US dollar, particularly against the euro and perhaps the Japanese yen, and to some degree may help also keep a lid on Aussie dollar rallies. In Australia, the focus will be on Thursday's labour force data. January saw a small fall in employment, which may be at least partly reversed in February, while the unemployment rate should hold around 6%. Overall, first quarter job creation should be a lot slower than in Q4, which was very strong. This isn't likely to have a big impact on the outlook for Reserve Bank monetary policy, where Westpac continues to expect the cash rate to be held at 2% this year, but markets still lean towards the chance of another rate cut by about year end. The Aussie dollar is always a bit sensitive to the jobs numbers, so there may be volatility on the day. But overall, it's likely to trade a roughly 73 to 76 cent range over the week ahead, perhaps with some risk of a probe higher. This doesn't change our multi-month outlook though, with the Aussie dollar likely to soften into mid-year back towards the 70 cent area. We'll speak to you next week.